Is the Fed going to increase interest rates? Yes, probably so, and probably about 1.25%. So why am I saying that? Well, let's look at the data and you can gauge for yourself if it supports that statement. We have a chart up here. The blue lines are the inflation rates on a month-to-month basis for roughly past 3 years. And the orange line is the Fed funds rate. Now we can see the high water mark right around June of 2022, and the high water mark of inflation was 9.4%. And I've got to say, impressively, as interest rates were raised, and the impressive part is how quick inflation was brought down with the raising of interest rates. I would have estimated there'd be much more of a lag, but it's almost real time, 1-to-1, when you look at it on a chart. So where we're at now of most importance, I would say, is if you look at roughly some of the last data we have, September of 2023, we are at roughly an inflation rate of, according to the chart, it looks like it's about 3.5%, but the actual number is 3.7. So is there a concern that inflation is at 3.7%? And unfortunately, there is. And the concern is that it's above the Fed's benchmark of 2%. So since it's above their benchmark of 2%, odds are good that they're going to be trying to get it to 2%. How do you get it to 2%? You raise interest rates. And interestingly, this data, if we look over roughly the past 16 months, it gives us a way to gauge how much interest rates are impacting inflation and how to estimate what the necessary movement or increasing of interest rates will be to bring inflation to the benchmark of 2%. So roughly this is, the calculations are below, but just to quickly walk you through it, we took a look at the high water mark of inflation, which was 9.4%, subtracted out the current value of 3.7%, and we noticed, or it identified, that the Fed was able to impact inflation and reduce it by 5.7%. And they were able to reduce it by 5.7% by increasing interest rates by 4.1%. So when we divide those numbers, we see that 1% change in interest rates impacts inflation by 138%. Now that we know that number, we can then go, okay, how do we estimate the change necessary to get to target? So if you look at the very bottom of the calculations, we see that we're at 3.7. We need to get to a target of 2%. The variance is at 1.7%. And if we use our factor that we've already derived of 138%, voila, it demonstrates that to get our inflation down based on the past trends of interest rate increases, we will need to increase them an additional 1.23%, which will take our current rate of 5.33% and increase it to 6.56%. So everyone, if the past 16 months tends to hold as is and have the same factors at play and have the same responses at play, we're looking at another 1.23% increase in order to get to the 2% Fed benchmark.